So clients see clearly, Mark. Consensus saw treasuries this time last year as almost uninvestable with a 5% handle. Today, we've got sub 4% yields and the 60-40 mix is sort of back in vogue. How do you see the outlook for the dollar, for treasuries, and for gold, given the Fed outlook?
Well, they're all connected. Essentially, the Fed, people think they set the long-term discount rate, but effectively they set the price of where you can hide your money. And in 2023, people were hiding their money in cash because they've been very bruised in 22. And essentially what we now see is as the Fed is cutting rates, not by very much, the real impact is not going to be on the economy, not on the US economy, it's actually going to be on the dollar. As that money, particularly a lot of international investors will be parked in US cash, not US bonds, and they're not going to switch to US bonds, certainly not at these prices. Much more likely they're going to move into gold, they're going to move into emerging market currencies, emerging market debt. And I think that's the most likely combination of the Fed move now will be positive for gold and actually lead to some diversification, I would put it, out of US assets more generally.
Mark, you've been critical of the supercharged mega cap monopoly margins driven by aggressive lobbying. What political and market risks threaten the Magnificent Seven in your mind?
Well, this is actually the reason why the US economy has been growing fine, but the US stock market has been going gangbusters relative to the rest of the world. It is the fact that the setup in the US has been consolidation. It has very favorable tax treatments. It has supernormal profits, particularly from monopolistic or semi-monopolistic behaviors. And when people like Warren Buffett talk about investing in companies with moats, what they're really saying is what we can do is we can find companies that essentially have very little competition against their margins. And US corporates work very, very hard, we all know that, in order to protect those monopolistic, semi-monopolistic margins. What I see happening now is two things, one of which is pure competition, and China is part of that in terms of producing better products at lower prices and basically forcing their way into distribution shipping. The second thing I think is that politicians are starting to turn, and the only person left to blame for the problems, unless you want to blame a politician, are the big corporates. So we're starting to hear some of these comments about price gouging. And so we had Joe Biden talking about shrinkflation. Now we have Kamala Harris talking about unfair pricing. In the UK, we're starting to have the new government there start to talk about unfair pricing and so on. So I think we're going to start to have some pressure coming onto all of these global mega caps. And obviously the Magnificent Seven are caught in both of those. On the one hand, we've just seen some antitrust action in Europe against Apple and Google. But the second thing is these companies, they can't get into the rest of the world as easily as they could previously. And that's from competition. You can block China coming into Europe if you persuade the European politicians to go along with it. You can block them coming into the US. But as the rest of the world, you can't stop the competition. So a combination, therefore, of politicians trying to avoid blame for inflation and high prices, and the actual market response, which is ironically coming from so-called communist China, is the most capitalistic of responses, which is massive increase in supply, and how you're dealing with that. So the final, as an illustration, think of someone like NVIDIA. Now, NVIDIA isn't allowed to sell its very best chips to China, but the chips it is allowed to sell, 6 months ago, we were being told it's going to take China 5-10 years to catch up with this. They've already done it, to the extent that NVIDIA is having to cut the price of the chip it is allowed to sell in China to compete with Huawei. Then you've got a situation with Apple. Apple is trying to enforce its dominant market position of wanting, the 30% margin out of everything that's advertised on Chinese social media. And the Chinese are saying, well, if you don't update the software, which is the way you're threatening us, then you'll never sell another iPhone in China. And it's like, you got caught out. What was your effectively sort of impregnable fortress is now crumbling in the face of, the irresistible force and the immovable object.
On the subject of China, the recent industrial numbers signaling quite a big slowdown there, or risk of slowdown, additional slowdown. How do you read that at the moment, and do the authorities there need to take action?
Living in China, effectively living in Hong Kong, we see a very different version of China to that which is represented in most of the Western media, and which is one that we think China has to behave like us. And we can't understand why it simply refuses to do that and continues to prosper. So we keep recommending that what China should do is stimulate its consumer to stop being in a deflationary spiral, et cetera, et cetera. We view that as a total misreading of the way that the Chinese economy is growing and will continue to grow. And essentially what we've got here is, it's a market in action. Take the property market. There is no problem with the property sector. There's a problem with the property developer sector, but that's one that has been deliberately engineered by the Chinese authorities because they've served their purpose. They've allowed the Chinese to move 100 million people from the countryside to the cities. They had to have somebody build proper public-private cooperation, somebody build the apartments. Now they've built enough apartments, they started getting into speculation, they get shut down. Obviously, we then have a situation with the EVs, where you start off, you've got hundreds, if not thousands, of competing EV companies. The ones that are left are the sort of the fittest and the most efficient, and those are the ones that are challenging the rather inefficient and uncompetitive European ones, and both sort of quality and cost. And what we see, of course, further down when we look at these big industrial production figures, yeah, those are things like steel and things like shipping and so on, which reflect a lagging supply adjustment. They're built too much. Okay, well, the market price will adjust, and then we'll see the price fall, and we'll talk about deflation and how you need to stimulate demand. No, the price falling is the adjustment. And we've got in such a weird world here where the Chinese give us a 5-year plan, tell us what they're going to do. They put things in place and then let the markets deliver most of the outcomes. In the West, we have the opposite, where no government appears to have any plan whatsoever, but they're constantly trying to manage the markets, mainly by trying to sort of G up demand to meet any excess supply, as opposed to allowing, ironically, creative destruction is alive and well in Asia, but is being kept away from reality in the West. So no, I don't see the Chinese need to do anything at all. They certainly don't need to stimulate an economy by encouraging over leverage and over indebtedness in the consumer sector, because that's the mess that the West has got itself into and is struggling to get out of. So no, I just see this as market adjustment and is helping.
Talking of which, Mario Draghi's recently released 400-page report on stimulus measures for European industry. How do you view that? Hail Mary pass or a self-induced competitive collapse?
Well, the big issue, the self-induced competitive collapse, of course, is essentially twofold, both of which are globalist measures to do with energy. Firstly, you've got what I would call the green leap forward, where the kind of net zero policies that are being imposed centrally are forcing up the price of energy right across Europe in particular. And then secondly, on top of that, we now have Europeans being encouraged, shall we say, to follow US foreign policy and impose all the sanctions on all their commodities that they were getting from Russia in the wake of the Ukraine invasion back in 2022. So Europe has basically priced its industry out of the market, and we see that on every indicator coming out of Germany. You want to talk about slightly slowing Chinese production? Look at what's been going on, particularly in Germany, which is the industrial powerhouse of Europe. And they're relocating to the US, and they're relocating to China. Now, China is accidental. The US, I'm not sure if it's not entirely accidental that the US is benefiting from US policies making European manufacturing incredibly uncompetitive. But so long as that continues, it doesn't matter what Draghi or any of the bureaucrats or the money men come up with. You're not going to change the situation, which is simply one of the fact that your energy costs are too high to compete globally. So what does the European Union do? What it's always done is it tries to lift itself up by its regulatory bootstraps on the idea that government can regulate its way into prosperity, and it doesn't work. It never works. So it makes it very difficult for European companies. And again, from an investment point of view, you've got really quite subdued demand. You've got people like the new government in the UK who think the idea to grow an economy is to raise taxes. The only way that works is if government can allocate the capital that they raise in taxes in a more efficient way, a more productive way than the private sector. I've yet to see that happen. So what we're going to see is a lot of opportunity as companies and people start moving, and really, follow the margin, follow the money. So no, I mean, 400 pages. That's sort of a regulatory lawyer's idea of how to grow an economy, but I don't think it's an investable one.
Thanks, Mark. That's great. Before we let you go, how about you just summarize for us some of the major bets that you have in your thematic global fund at this point?
Yeah, thanks, David. Yeah, well, what we try to do is we don't invest in individual stocks. We try to take out that stock-specific risk and instead invest in longer-term thematics, and then we allocate dynamically into those themes where we see the risk returns are looking attractive. So we can like a theme such as the Japanese wholesale companies that are more known as the sort of the Warren Buffett trade of borrowing yen and going into all those Japanese international trading companies. We can love that theme, but actually we might not have any allocation to it at the moment, which is where we are at the moment, because the risk return doesn't look right for various reasons to do with the unwind of that trade that we saw back in the summer. Similarly, some of the robotics and automation companies have all got caught up in that disinvestment flow coming out of Japan. But ultimately, with rates doing what we see they're doing, which is coming down, but not aggressively, we see renewed remaining attraction in global high yielding stocks. Quality high yield cash flow has been a long-term theme for us that remains very much in place. Gold is obviously one of the balancing themes that we do have, and we see that as being a beneficiary of the weaker dollar. We are more global because we do see a need to diversify away from the US. The US is 70% of global equity markets, but we don't see it as 70% of global equity opportunities, that's for sure. But essentially, we're trying to buy into some of these medium to long-term things, many of which are in the digital space, and we're doing it via some of these more focused ETFs without being too focused, if you like. We still like commodities and energy, but again, we're not aggressively right at the moment. Emerging markets, I think important to say we've split our approach to emerging markets to carve out China, not because we don't see a lot of opportunities in China, but we recognize that there's a lot of people who feel, for whatever reason, that they cannot invest in China, but they also want to invest in emerging markets. So that emerging markets ex-China has been a theme that we've been playing for well over a year now. We've parked our China theme elsewhere into China, internet and consumer. But again, at the moment, we love the long-term story, but we don't like the way the price action is working at the moment. So that's on the bench rather than on the pitch, if you think about it as a player for us at the moment. So we're global, we're diversified, we're not picking specific stocks, we're trying to play into these things. It's about quality, cash flow, sensible long-term compounding investing, to be perfectly honest. We're not playing aggressively size small caps at the moment. We're not aggressively playing value. Momentum has had a wobble if we're talking in the world of factors at the moment, but momentum remains quite a powerful thematic here, but mainly we see the allocators is gravitating into that min vol space, that minimum volatility space. So ultimately what we're trying to do in my fund is we're looking at the behavioral behaviors, if you like. So it's behavioral finance. We're looking at the behavior of a trader, of an asset allocator, and then of ourselves as long-term investors. And we're just saying that recognize that you as a long-term investor rarely is setting the price. It's being set by these other guys. So bear in mind, what are they doing? And I see essentially the traders flatten their books going into the summer. Some of them had a horrible August because frankly, they were forced to buy at the top or sell at the bottom. But most of the asset allocation just kind of sat through it. It went down, it went back up again. And then, well, there's a yen carry trade. What do I do now? And I think, you know, they'll do kind of think like we're thinking, I think, which is, I think the dollar may well go down. I'm not going to bet on it, but I need to make sure that if it does happen, that my portfolio is reasonably robust in the light of that. So start to diversify, start to have focus on gold, commodities, emerging markets, and so on. So that's how we're trying to position. We're not betting, but we think that, you know, the situation as we see it likely to unwind, we'll get some small tailwinds and we'll avoid most of the headwinds is the way we're hoping for it.
Mark, many thanks on behalf of So Clients See Clearly. If anybody wants to get further in touch with Mark and hear more about his ideas, the best place to go is his blog on market thinking. The details are attached below. Thanks, Mark. We look forward to chatting again soon.
Thanks, David. Enjoyed it. Thank you.